Hello, everyone. We are delighted to welcome you today for this new ICMA webinar focused on the topic of sustainability-linked bond as it relates to the selection of core material and relevant targets to be incorporated into the financing conditions of bond instruments. I'm Samin Mary, as it was alluded to, ESG research analyst at PIMCO. PIMCO is one of the coordinators of the Sustainability-Linked Bond Working Group, and I'll be moderating this panel alongside Laurie Cheney, who is the head of Green and Sustainable Finance and Advisory for EMEA at Natixis CIB. Just to share some context and set the scene before delving into this topic, this is the second in a new series of ICMA webinars focused on the sustainability-linked bond instrument. We had last month the introductory webinar and are planning the next webinar on the topic of sovereign. But for today, importantly, we would like to make this as concrete and practical as possible. So the overarching objective of this webinar is to complement the existing ICMA guidance that is extensive and you can find on the website and includes the sustainability-linked bond principles, the Q&A, the KPI registry, as well as the checklist. And the focus is very much on the practitioner challenges and some of the potential solutions associated with the market realities. Today, we would like to focus on the first component of the sustainability-linked bond principles, which is the selection of core KPIs, and particularly emphasizing the concept of materiality and what it means in practice to focus on or to select targets that are connected to financing conditions. And we'll take the example of greenhouse gas emissions, which has been one of the most widely used KPIs in the context of SLBs, to look into best market practices and some of the considerations associated to that. Importantly, we'd like to highlight up front that SLBs as an instrument aims to be inclusive, so accessible to issuers at various stages of the sustainability journey and operating in diverse environments. But at the same time, the ICMA guidance from the start has tried to encourage and emphasize criteria and factors that can essentially help issuers build frameworks that are as relevant, as ambitious, and robust given today's market realities. In the context of greenhouse gas emissions, the topic of scope 3 will be addressed in more detail today because we think it's a particularly interesting case in point to consider what materiality means in practice and the extent to which the sustainability-linked bond instrument can be seen as a tool that is essentially helping to enhance the transparency and accountability of issuers in relation to their transition plan, greenhouse gas emission reduction targets, and that there are already some positive examples in the market that can inspire other issuers. And we'll have 4 panelists, and we are very pleased to have such expertise and rich experiences that will be supporting the discussion today, starting with standard setters or methodology and research providers with the Science-Based Targets Initiative represented by Peter Uhlenbrook, who is Financial Institutions Engagement Manager at SBTI. We are also pleased to welcome Valentine Yan, who is Deputy Director of Research and Operations at the Transition Pathway Initiative. We'll also hear from the sort of research and data side from Rob Zhang, with Sustainable Debt Data Analyst at the Climate Bond Initiative. And importantly, for the practitioner perspective, we will have Harm Jan Peterson, who is Director Investors Relations at Ahold Delhaize, an issuer of sustainability-linked bond. Thank you very much to those who have shared questions in advance. I will essentially make sure that they are guiding the discussion as much as possible. And without further ado, let me start with the first question for CBI and Rob. We'd like to set the scene further. Given the research that CBI has produced on the sustainability-linked bond markets, we'll be interested in the main takeaways of your research on the momentum for material and ambitious targets incorporated into SLBs, including Scope 3. Would you be able to share also examples of SLB issuers that have already shown some good practices in these areas and that can potentially be replicated by other issuers?
Sure. Thank you, Samuel, for your kind introduction. Hello, everyone. So at CBI, we maintain a SLB dataset with more than 1,100 deals. I'm in charge of collecting and analyzing these KPI against our publicly available. I did a quick pivot table yesterday. So out of these 1,100 deals, there are 500 deals have any scope of emission as their KPI. So that's almost half of the total SLB market. Among them, 81 of them only include Scope 1 emission. 291 deals have Scope 1 and 2 emission. Some deals include partial Scope 3 emissions, 14 of them, and 112 deals have all three scopes of emissions. So they essential to demonstrate a credible and ambitious transition. Because I analyze those SLB against sector-specific pathways from TPI, SBTI, Kareem for real estate, and our CBI sector-specific pathway. Issuers from different sector would require the scope of emissions material to that sector. And for those sectors doesn't have a specific pathway like media or finance, we would require all scopes of emissions or at least 80% of their total emissions. To answer your second question, yes, I'll share some examples of SLB issuers that have shown good practices in these areas that could be replicated. Rome airports, they set Scope 3 emissions intensity targets using kilogram CO2 equivalent. We're not anti-growth, so they have more passengers. They can have more passengers and higher total emissions, but it won't be too high as they are getting the emissions per passenger down. Heathrow is also a good example. They are covering not only the airport's underground emissions, but also in the air emissions. Securitas, a Swedish security company, they stated their 2020 baseline emissions and 2030 target year emission in all scopes of emissions on absolute numbers. Boom, 42% off, very good. One example from EM is Qingdao West Coast Utility Groups from China. They have a very high baseline emission, but they have a rapid emission reduction pathway. Although their target year emission is not low enough on absolute numbers, but their percentage reduction is considered ambitious enough, and it's aligned to TPI utility pathway. This shows that there are huge potential for EM issuers as well. Thanks.
Thank you, Rob, for this first introduction with really concrete figures. Maybe now moving to you, Peter, from your views. Can you share your insights into the momentum for the verified science-based target for Scope 3, your requirements when it comes to the integration of Scope 3, the coverage? And here we've received a specific question from an SPO provider, questioning and challenging how to assess actually the question of the materiality and how to consider the alignment with the principles when we say core, relevant, and material, and how you will cover that from an SBTI perspective.
Yes, no, thank you very much. And thank you for the introduction. It's wonderful to be here representing Science-Based Targets Initiative and contributing to such an important and challenging topic and discussion. But I might begin with some updates and progress from the SBTI's perspective. So for those of you that don't know, the SBTI has been around for 10 years and we were established in 2015. Back then, there were just a handful of targets. And now we've reached a huge milestone. We've had 10,000 companies either with validated targets, and there's around 8,000 of those, and a further 2,000 that have committed to doing so. So we've made enormous progress, scaling, traction, and I think we're at a point now where Scope 3 target setting has become a norm or mainstream in this, and there's a good reason. It's because of the SBTi's approach to Scope 3 target setting. So for example, for the near-term target setting criteria, companies are required to set a Scope 3 target when Scope 3 emissions represent at least 40% of combined Scope 1, 2, and 3 emissions. And we know in practice this for real economy companies, emissions generally, Scope 3 emissions generally represent at least 70%. So in practice, real economy companies, and this is excluding SMEs, almost everyone now is including Scope 3 targets. So it's a norm. Something to highlight that I think is quite interesting from the SLB issuer perspective is like to signpost to a study that was published recently in the Journal of Climate Finance, which did some research into the near-term share price performance of issuers issuing SLBs. And it found in the 3-day trading window following issuance of an SLB, there was a correlated share price increase of around 0.44%, 0.44. That's good news. The market's responding really well. Now, for SLB issuers that also have a science-based target, that's doubled to 0.88%. And I think what that speaks to is market confidence into companies with an SBTi that sort of shows a robust approach to target setting. And I think this comes back to Scope 3 target setting because of the stringency of those requirements. So those near-term Scope 3 targets, they have to cover 67% of Scope 3 emissions. That's been the approach so far, and they can use a range of target setting methods to do so. They can use absolute emissions reduction target, which tends to be the most popular. It's around 64% of Scope 3 targets using that approach. Food and beverage tend to be the most popular sector there. Companies can also use intensity-based emissions reduction targets. They're less popular, but still widely used. They're physical, economic, or sector decarbonization style targets. It's around 22% of Scope 3 targets following that approach, favored by software services and professional services. And there's also the supplier engagement target setting method used by around 14% of Scope 3 targets, favored by software services, retailing. I think what's really interesting, and I think I might answer that question about materiality and relevance over the course of the discussion, because I think there's some ground to cover first before coming to a clear answer, but I will by the end of the Q&A. But I think what I really want to highlight at the moment is that regardless of the target setting method being used to cover, those 67% of Scope 3 emissions, we generally find supplier engagement is really being leveraged and harnessed to drive progress, both in the action ambition, but also the quality of underlying data there as well. And interesting, we started asking companies reasons why they set a science-based target when they come to us for validation. The number one reason is that they're hearing it from their procuring companies. So it's this supply chain pressure that I think is really contributing to the scaling of companies setting SBTIs across the global real economy. And I have a lot more to cover around the evolution moving forward, but I think I'll come back to that later on in the session. But I hope that gives a little bit of a flavor of some trends that we've seen so far.
Thank you, Peter, for your insights. To complement this perspective now, I'd like to raise a question to Valentin from TPI. So TPI has particular expertise in high emitting industries, assessing their management qualities, their alignment with the Paris Agreement on climate change based on their greenhouse gas emission reduction pathways. So I'd like to hear from you which sectors and companies you think are the most advanced in setting ambitious and robust targets that incorporate Scope 3 where appropriate. And also on the contrary, we'll also be interested to hear from you which sectors and companies you see lagging behind in terms of disclosure and target setting on Scope 3, where it is highly material. But also perhaps if there are examples where these issues may be lagging behind for a good reason, meaning that there are real economy challenges for target setting on Scope 3, and perhaps there can be other KPIs, other proxies that demonstrate their ambition in terms of decarbonization without necessarily being Scope 3 per se, but some alternatives, some proxies, some levers or complementary KPIs.
Thanks for that question, and also really great to be here. To answer your question, I think it's worth just spending a tiny amount of time on how we look at the sector and our approach, so that the results kind of make more sense. So at the TPI, we look at the decarbonization targets of companies and their alignment with the low carbon scenario, and that affects how we look at these companies. So we essentially, what's the kind of data environment that we need to make this kind of judgment? We need to have the corporate data. So we're looking at information that companies already disclose. We need to have scenario data. And we also need to ensure that companies have a relevant activity-based denominator, physical unit denominator. So for example, tons of steel. So we're really looking at the high emission sectors, and within that at very specific activities. What that means is that, for example, you can have a conglomerate with lots of different activities, but we will always do our assessment on the activity basis. So if you have a company, I don't know, selling steel and cement, just for the sake of argument, we would have 2 separate assessments for that. Our focus on when it comes to scope 3 is really on within that kind of setting, where is the transition risk concentrated for a company? So for example, in oil and gas, it would be, the burning of the oil and gas products. For a car manufacturer, it would be selling the cars, but for a cement or a steel company, that would be the actual act of producing steel or cement. So within all of that framing, the sectors that we look at for scope 3 specifically are oil and gas, diversified mining, coal mining, car manufacturing, and the food sector. Within that, we find that the car manufacturing sector by far has the best scope 3 target setting, and that makes a lot of sense. There's a lot of regulation around intensity targets in the EU, for example. The technology is there largely. In the oil and gas sector, we have seen some scope 3 target setting for scope 3 category 11 use of soil products over the last couple of years, but those targets have been weakened in recent years. And in diversified mining, it really depends on whether companies see the transition as a risk or an opportunity, but there also we have quite significant target setting. In the food sector, we do have some target setting on scope 3, but because the emissions are so distributed and come from such a large number of different processes and products and places, that has really, really limited the scope there. So I think the sector as a whole seems to look at the transition and especially engagement with their suppliers, as I think Peter was mentioning, as an opportunity. But there are serious measurement issues, and that limits the target setting. I would say on that though, is if you look at the entire exercise, whether you get an intensity in a pathway that's 3, 4, 5, 6% different on an alignment perspective, that is not very, that's not that important, because the reduction rates are 50, 60, 80, 100%. Right. So if you look at it from that perspective, just purely on the alignment, I think it's important to not get carried away in this kind of marginal utility of getting slightly more accurate data. I do see that with an SLB, if you have an actual contractual obligation against those kind of measurements, then that becomes a different story. But I just thought it's worth highlighting that there is also a process that you can go through with the company on those kind of data.
Thanks, Valentin. Good to hear. And you mentioned the food sector, and Peter, you mentioned as well the retailing one, where you definitely mentioned the engagement with suppliers. So interesting to now to go from a practitioner perspective. You are the SLB issuer in the room, Jan, so really interesting. I'm sure that the audience will be keen to see what challenges did you face when contemplating the incorporation of scope 3 in an SLB, and especially how did you address those challenges?
Yes, thank you, Laurie, for the question, and also thank you for the team to having me on this webinar. I think I will come to your question, of course, but let me briefly sketch some few of our company, because I think that's important to set the scene. So Alvarez is a global food retailer. We operate in 10 countries with 17 brands, and our brands have a range of products from 25,000 to 60,000 SKUs on our shelf as stock keeping units. So we have quite some products to cover if we look at our Scope 3 carbon emissions. We work with more than 10,000 direct suppliers. They all have suppliers to get ingredients, packaging in there. So, and then also downstream, we have around 70 million customers visiting our stores every week, both online and in our stores. So in the full value chain, there's a lot for us to measure. If you look at our Scope 1 and 2 carbon emissions and our Scope 3 carbon emissions, then 95% is coming from Scope 3, and around of that 85% is coming from Category 1. So for us, the Category 1 products and services is by far the most important one. And when we were looking into to setting a target on Scope 3, you can imagine that collecting all this data was an issue. So we could think like we want to be perfect and get all the data from suppliers, but that's not an option. So we went with all the information that we had into our systems and came up with a baseline figure. So we used weight data from our products. So just the number of grams a product is weighing, we multiplied that with the number of products we purchased, and we used a factor from Agri-Belize or from another benchmark to make sure that we calculated the carbon emissions per product category. For the products where we did not have weight, we used a spend analysis. This was around 34% of our total products. So 66% we have to weight from, 34% we don't have to weight from. So we use purchase spend, and also there we use conversion factors to calculate carbon emissions. So based on that, we were able to calculate total carbon emissions from our products and services category. And then to include it into an SLB, that was another step, because one of the things we believe, if we put an KPI into remuneration for our management or in an SLB where we work closely with our investors and with our debt investors, we want to make sure that we have robust data management. The thing we don't want to have is that we issue a target, we report progress, and then 2 years later we have to say, oh, there was an error in the data, we have to change it, but then all the interest rates are already changed and the money is already distributed. So we looked into how to tackle that. We had Sustainalytics as a second-party opinion provider, which helped us a lot also in thinking with us, how can we do that? There was no option to exclude Scope 3 in our sustainability-linked framework. So that is something we had to include. And the conclusion we got is that we now have a target in our SLB that goes to 2030. So for Scope 1 and 2, we have interim targets. For Scope 3, we don't. So we have a target that ends in 2030. Which gives us the time to really increase our data management systems, work with suppliers to make sure we get better data, but also that we can capture initiatives where we actually reduce carbon emissions. And I will come back to that later in the webinar to explain a bit what we are doing, but to make sure that we can also capture initiatives, because if with the current method, we can only capture the initiatives based on assortment change, but not, for example, on changing farming practices, because we use those average conversion factors. And then to finalize my answer, one last thing we did, we included Scope 3 carbon emission programs. So every brand needs to build a program, and we included that into the management board remuneration. So our management board and leadership got a percentage of the short-term incentive based on the quality of the plans the brands have to further reduce carbon emissions along the way. And that is also something that really helps to give attention to it, but also to have robust plans in place, transition plans, to make sure we actually are driving down the carbon emissions going forward.
Thank you. I think that's particularly valuable to hear all these concrete challenges and how you have overcome it. And if we turn our attention to SBTi, so you have heard similar challenges from many companies. And when you think about the revisions to the SBTi standards, how do you look at concrete solutions to help essentially issuers in their decarbonization pathway in relation to Scope 3?
Yes, thank you, Samuel. And it's interesting hearing Hamyan's feedback. It's very similar to the feedback we've heard from a range of practitioners. And one of the things that SBTI is really focused on is listening to practitioner stakeholder feedback, or indeed feedback from a wide range of stakeholders. And we're currently in the process of doing that for, you mentioned we're doing a public consultation on a major revision to the corporate net zero standard. This is a major project of work. The consultation is open until the 1st of June, so still a week to go and get in those responses. And what this revision process is going to do is to address some of the challenges and limitations around Scope 3 target setting. We've already heard some of those around tracking emissions data and setting concrete targets and evidencing process against those. So last year in July, we published a Scope 3 discussion paper, which outlined this in detail, but there have been some proposed or solutions to address some of these, and I'm going to lift 3 or 4 of them out because I think these are really important also from an SLB practitioner perspective, because I think we might see a new generation of Scope 3 targets that might be easier to track and have more granularity and nuance on their place in the value chain. So firstly, I spoke earlier about the 67% target boundary for Scope 3 emissions. So one of the major changes is to replace that by focusing on relevance of emissions. So rather than having a fixed blanket threshold, targets, the proposal is to set targets on Scope 3 categories where a particular Scope 3 category represents more than 5% of total Scope 3 emissions, and also emissions from emission intensive sectors where they represent 1% of Scope 3 emissions or greater, or 10,000 tonnes a year or higher. And there's a list in the consultation standard outlining those activities. So this will lead hopefully to a new generation of Scope 3 targets that are more relevant to issuers and to really prioritise action. The second really important update is around introducing more flexibility into target setting options that go beyond emissions dependent metrics, methods, and approaches. And it will do this by introducing alignment target setting metrics and methods. I think this is huge. And what this will do in practice, it will introduce more nuanced target setting that are alignment based across upstream and downstream separately. So for upstream emissions, in practice, this could look like a share of procurement directed towards entities and activities that are aligned with global climate goals based on benchmark performance. And we have a ton of existing benchmark alignment data out there that can be really leveraged and practically useful. On the downstream side, it could look like share of revenue derived from net zero aligned products and services. So I think having this style of target setting can really be leveraged in SLBs and having more granular and nuanced sustainability performance targets. It's worth noting that the corporate net zero standard is also introducing a more nuanced approach to substantiating progress against those targets. So there'll be continued focus on direct mitigation efforts where there's full traceability in the supply chain, but it will also allow for indirect mitigation measures in parts of the supply chain where there's zero traceability. So this really accounts for influence in the supply chain and be able to incentivize action taking to address all kinds of emissions. So I think that's also a really important feature of the standard. And I think the final point I'll make is, and this is related to improving data quality, which everyone is struggling with. The proposal is for companies setting a net zero standard to provide assurance of their greenhouse gas inventory. So now imagine the companies in your supply chain are also providing, not only setting targets and disclosing, but providing third-party assurance behind that data. I think that will go a long way in improving the quality of data. So a lot of exciting updates and changes, which I think will be relevant for relevance and materiality perspective. There, I might pause there. Don't want to take too much time.
Thanks, Peter. Question for you, Rob. At Climate Bond Initiative, you are assessing issuances as well as the issuer themselves. So interesting to make the link between concretely the example that you have seen from a transaction perspective, or that could be interesting levers that issuer can use in their transition plan as a proxy KPI, as we say that, just to cover the question of the scope 3, but with other alternatives and solutions that could be concrete actions, for example. So what type of proxy you see as relevant, and how to set ambitious targets linked to that?
Sure. Yeah. I can present you some good examples on SLB with similar or related scope 3 proxy targets. But before that, can I make it clear that some issuers, they use economic intensity targets in scope 3. As CBI, we consider it less ideal. We can compare CO2 per ton of cement across different companies, but not CO2 per ton of cement revenue. So one Italian airport company, they use economic intensity, tons of CO2 equivalent per million euro spent, which is the capital expenditure linked to infrastructure development. But still is better than not do anything, right? So with that out of the way, I'll show you some good scope 3 proxy examples. So for financial companies, Kinnevik, a Swedish investment company, and Capman, a Finnish asset management company, is doing very well in terms of target setting. They included all scopes of emissions, and the reduction pathway is in line with SBTi absolute contraction approach, the ACA. Other companies, they have used all sorts of KPI in addition to scope 1 and 2. Other financial companies, including loan portfolio GHG intensity, investment in SBTi validated companies, leasing amounts in renewable energy, annual capital investments in green industries, project with ESMS implementation, home loan balance for energy efficient buildings. Other non-financial corporates also have very good proxy targets. A good example is L'Oreal. They used a quick cradle-to-shelf GHG emissions per sold product, which they consider some upstream and downstream supply chain management in order to reduce their product carbon footprint. They also include share of recycled or bio-based plastics used in packaging as one of their KPI. This also contributes to scope 3 emission. Precious Shipping, a Thailand shipping company, they used annual efficiency ratio. This unit is a gram of CO2 per ton per nautical mile, which is great indicator in this industry. OVS, an Italian clothing company, they would require the suppliers to have a third-party sustainability verification on environmental and social aspect. Gold Story, a French jewelry brand, they asked their suppliers to be ethical in mining. Natura, a Brazilian cosmetic company, included post-consumer PET input proportion as their KPI, as plastic is most widely used in packaging product in their portfolio. And lastly, one Japanese issuer said they will encourage their major suppliers to obtain science-based targets by 2025 and promote the reduction of GHG emissions throughout the entire supply chain.
Thank you, Rob, for all these real-world examples that also resonate because they illustrate the use of many KPIs that are part of the KPI registry that ICMA has published, and they give a sense of sector nuances and the sort of breadth of the available options in terms of targets that can be deemed moving in the right direction, when not necessarily being scope 3 per se, but complement or support to scope 3 emission reductions. Turning now to Valentin again, there is one overarching challenge that is typically raised in the context of connecting scope 3 to SLBs, which is a level of control and influence over them. So how do you look at this topic? So in your mind, what are some of the key factors to consider scope 3 targets that can be in issuers' control to a certain extent, and for which there is a level of credibility in relation to the issuer's actions when looking at scope 3, and that may imply making a distinction between upstream and downstream emissions?
Yeah, absolutely. I think maybe to start with a distinction between transition risk or concentration of transition risk in your value chain and control. So our starting point is always where's the transition risk concentrated? even if potentially there is a relatively low level of control, just because from a financial point of view, you're still exposed to that risk. And that's particularly true with regards to your value chain, because yes, you can make, you know, if I look at our work in the banking sector, we focus a lot on investment policies, for example, and equally you could look at, you know, when you look at upstream emissions, you know, purchasing policies that require, you know, some certain environmental standards, but it's not exactly the same as having direct control over the product that is being produced, right? So I think the just to have that clear, transition risk is our primary lens, but you may not always have control over that. When we now move to SLBs, I think what's really important to keep in mind is that for the vast majority of companies, Scope 3 emissions are going to be concentrated in two categories. So yes, we have a palette of 16, but I think it's important to not go crazy with that and focus on you know, where are emissions concentrated, again, coming to my point earlier. So typically, you know, there'll be Scope 3 category 1 and Scope 3 category 10, which is processing of products, or 11. There are other sectors with other slightly different profiles, but that's I think you can largely think about it in those terms. I would describe it as sort of a matrix with two axes. On one hand, you know, is a product or a value chain homogeneous or heterogeneous? So for example, in the food sector, or even for a retailer, your value chain is going to be extremely heterogeneous. That's very difficult. Lots of different products, lots of different emissions factors, potentially very long supply chains. A homogeneous sector, let's say the electricity utility sector, will maybe have one or two products. That makes things a lot easier. So that's one dimension. The other one is, yeah, upstream or downstream. I completely agree. Upstream means you have direct control over the production process or the product itself. Downstream means you have, upstream means, you know, you should look at your procurement policies. To give you some examples, you know, a homogeneous downstream, I think, is the easiest case, right? This is oil and gas, this is autos. You have control over the product because the emissions are downstream, and it's homogeneous. You can set targets relatively easy. Auto sector is a great example of that, and we do have most targets on Scope 3 in that sector, also the most ambitious ones. Homogeneous and the upstream emissions. So that's when you think about policies and supply chain engagement. And that's, for example, a real estate developer. You know, they buy one or two different products. Heterogeneous and downstream emissions, you think chemicals. They produce a lot of chemicals, but the downstream application is massive. I think that's one of the most difficult ones, even though we're finding companies setting more targets. And then heterogeneous and upstream emissions, I think that's sort of, you know, where you start looking at the food sector, where, you know, a Nestle or a Danone would have a huge base of different farms, et cetera, that they source from. And that's, again, procurement policies and supply chain engagement.
Jumping on this question of supplier engagement, you just mentioned, Valentin, for you, Amgen, as an heterogeneous and upstream value chain, as illustrated in your purpose. So how do you practically engage with your suppliers to tackle these upstream emissions? We were mentioning previously the means and the levers that you have in place for your Scope 3 targets reduction. So interesting to have your views on that front. And maybe to hear as well as a practitioner on the market, the feedback that you've received, both from the SPRO provider, but as well from investors in terms of their feedback on your measures, on your level of engagement with them, how they were supportive regarding your KPI selection and calibration.
Thank you, Laurie. I have two examples of how we work with suppliers. Now we engage with suppliers to tackle the emissions, and then I will go to the investors. First of all, as Peter said before, we do ask our suppliers to commit to SBTi as well, because we believe we follow SBTi. We have our targets approved by SBTi, both Scope 1 and 2 and Scope 3. And we believe that's a very good process, or to, first of all, get a good insight into your current carbon emissions, but also then it gives you tangible example of how to reduce that. Where are your hotspots? And secondly, we ask our suppliers to submit data to us. So we can, as I just explained, replace the estimated data with actual data from our suppliers, which gives us a much better view on the actual carbon emissions. So within our European brands, to do this, we have set up climate hubs. Those are websites where suppliers can enter, or which they can visit, where we have videos, scripts, examples of how we set targets, how to set a target, how to measure your carbon emissions. For the larger companies like Nestlé's, Coca-Cola's, that's perhaps not needed, but we also work with a lot of private label suppliers, with smaller suppliers directly with farmers. So for them, those websites are really useful to get an understanding of what is expected and what do you need to do. So every brand in Europe has their own website in native language, so they can really easily access that. In the US, we have a slightly different approach, and I think that's good because we can learn them from the different regions where we operate. In the US, we are setting up pilots. We currently have 3 pilots running with suppliers on regenerative agriculture. So we have one with Kellanova on wheat farming, one with Campbell's Soup on potato farming, and one with General Mills, also on wheat and oats farming. And there we are testing different farming techniques to see how can we capture carbon into the soil, or how can we reduce carbon emissions from the production process. And based on those learnings, we are planning to scale that going forward as well, also to actually capture or reduce carbon emissions directly in the moment products are produced. And then a third element, which is not directly supplier engagement, but we do work with our suppliers, that is we look at our current assortment. So we have look into what is coming from, what proteins are coming from plant-based products, which proteins are coming from animal-based products, but also making that shift will help us a lot to reduce Scope 3 carbon emissions. And that's more in the assortment change. So we need suppliers to do that, but it's also a lot in customer behavior change. But that's another story. Then looking at the investor response, for investors, what we learned is very important that we align our sustainability-linked bond targets with our strategy. And because Scope 3 is a big part of our sustainability strategy, it's also expected that it is in our sustainability-linked bond targets. So we are consistent with our strategy. We already issue sustainability-linked bonds since 2019. First it was with carbon emissions, Scope 1 and 2, and food waste reduction. But now, since 2 years, we added Scope 3 in there as well. So that evolution is also in line with the strategy and what investors expect. And I think another very important topic for me is that the conversation we have with investors shifts to how can we reduce carbon emissions, instead of why don't you have a target or why don't you have a commitment. So we even have investors where we look at partnerships or collaborations, or can we bring in more industry partners in the food retail or food industry together to see how can we, with investors and companies, find solutions to scale the reduction of Scope 3. So I think that dialogue it's much nicer, gives much more energy because you look at solutions. So that whole reception from investors is very well appreciated by us, but also by the investor itself. And then the last one, and I think that was very important for the investors, is that we have credible numbers. So we have an SBO provider for Sustainalytics who showed the investors that these targets and plans are ambitious. We have SBTi that approved our targets against a 1.5 degree scenario. And then we have KPMG that provides assurance on the numbers we report every year through our annual report. So that also helps us to show it's not only Aldo Haze that's doing this, we have third-party providers credibility on our numbers and assurance. And that also is for investors an important, important topic. Here I stop, looking at time.
Thank you. Maybe there is a question for you in the Q&A, so you can maybe keep the mic. And saying that when setting expectation for your suppliers on Scope 3 reduction, does that feed through into an expectation that cost of reducing emission will be shared by your customers? How to deal with that in terms of efficiency from an economic perspective as well?
Yeah, it's a question we get more often, and it's I fully understand the question because it's a totally different approach than scope 1 and 2, where you are fully responsible and this is directly into your own hands. So what we are currently doing with the pilots we are doing in the US, there is technical and financial support, and we work closely together with the companies I mentioned to make sure those pilots are successful. If you look at the larger CPG companies or the national brands, they all have their own programs in place. So I think it's very important that they have their own targets, their own commitments. And in my view, they also are responsible to reducing that. So from a financial perspective, I don't expect that as Aldo has, we will jump in, but from a support perspective, sharing knowledge, sharing learnings, partnerships, how can we work together there? I think Aldo has definitely has a role to play. And then we have 50% of our assortment, our sales in Europe, and 32% in the US is coming from private label products. And that is, of course, products that we put ourselves on the market. So there we are looking into how can we support our suppliers to make sure we help them to reduce carbon emissions. So we do the pilots, we have climate hubs in place, as I mentioned, and then our sourcing directors together with the suppliers discuss what is the best way forward to make sure we reduce those carbon emissions.
Thank you. We have another question that is supposed to be addressed to me, which is that what are the drivers that we see in order to support the growth of the SLB market? I'm happy to take it, but happy to take it for all of you around the table as well. What are the main levers? Definitely, and we've seen that in your experience at our delays, that the granularity of the information and the measurement is one of the key drivers, meaning that the more you will have confidence in your information and your data, the more you have the control on your emissions and then on the levers. So definitely we see that with all the different, let's say, disclosure regulation that we may have or constraint that we have from a data perspective, this is really helpful. And now issuers are more ready to use KPIs and are more comfortable to set their target because of the accuracy and the availability of the data. So definitely it's one of the drivers. And even if in the environment, the actual environment that we have that is maybe sometimes reluctant when it comes to the topic, companies are still moving. And the question of transition is still there fundamentally, and the engagement are still on the table. So I'm not sure that it will impact the market, but the sustainability roadmap and the transition journey are really still on there. So definitely, Marel is expecting to see continuously players on that front. I mean, this is a call for action that I have as well. And the fact that the maturity is growing is certainly a driver that will help. I don't know if some of you have other views or if you want to complement that. What are the key drivers that could help and support market growth? Anyone, or even you, Samuel, from an investor perspective or from an issuer perspective? Anyone want to give any views on that, the drivers for the market?
I'm happy to give an answer. I see Valentin is unmuted as well, but I'm not sure if you want to add.
No, go ahead.
Okay. I think what is helpful is what we receive a lot of positive feedback, and I think it's also to show the success of these bonds is really, it's not only helping to further drive our scope 3 carbon emissions, it's also helping to reduce our cost of debt if we are successful. Of course, if we are unsuccessful, we are not. But I think most importantly, it shows that working with investors, getting the right investors behind your stock, and also working with other companies to show that these tools help you to drive engagement, drive attention within the company. As I explained the projects we are running, I'm pretty sure that it's also driven by the fact that we have scope 3 in our remuneration, in our bonds, in our targets. So that whole set is really helpful. And I think if we are able to show that to different issues as well, I'm sure more will follow. So sharing successes, I think, is for me an important element there.
Yeah, I was just going to say earlier, I think one of the elements is also the proliferation of transition planning. So, and I think this is also part of CBI's approach, which is supporting targets with, you know, actual implementation plans, so that you can, which makes using those targets in a financial way much more realistic.
I might add one and follow it on, just to circle back to the study I mentioned earlier, that there's a positive market response to SLB issuances. I think there's investor appetite for companies to lead by example on having more robust sustainability practices, and I think that includes incorporating them into their financing activities. But there's business interest in having a robust and resilient supply chain, and I think having a supply chain on the decarbonisation journey is key, and that also means for them to set robust targets and to improve the quality of data in turn. So I see a strong business driver in securing supply chains, especially at this point in history.
And maybe one quick word from me from an investor perspective. We continue to see a strong momentum and interest in decarbonization driven by asset owners that have set their own commitments, their own pledges, are looking at the implementation, are focused on real economy decarbonization, and therefore SLB can be seen as a very powerful instrument in terms of supporting the data, the engagement, the transparency, and all the nitty-gritty details that we are discussing that are essentially supporting actions, initiatives that are moving in this direction, and that's important. And there is also an element of sector diversification. So we had this week, actually, for instance, a sustainability bond incorporating scope 3 in relation to the gas sector. So that's another example of a very challenging area where there are some innovative mechanisms, practices, and initiatives that are trying to drive SLB transactions focused on this materiality component.
And it's definitely a wonderful tool to engage dialogue with your investors. So definitely, and how to find the good drivers. And this is why definitely the ambition of this webinar is to give you some tips. So we hope that guidance and flexibility with, let's say, proxy KPIs can be helpful, but this is definitely a wonderful way to have an active dialogue with the investors. Another one which is interesting is linked to the SMEs. The different, let's say, tips or solution that you've suggested is maybe oriented for big corporate, but what about SMEs and how, when you don't have, let's say, sophisticated systems for data collection and you are really as a specific part in a full value chain, how you could advise them or give tips from an SMEs in order to select relevant KPIs and especially for target setting then. Anyone? I don't know, Peter or Valentin, if you want to take this one.
Yeah, I can. I can maybe just address the target setting, and then Peter, you can come in. On target setting, we're addressing this. So as I mentioned earlier, right now we're really focused on the largest high emitting sectors and methodologies and pathways for that, and that's also been available from the scenario community, IEA, IPCC, etc. The question is, and I think that's what we're looking at here as well, is how does that filter through the system? How, if you look at downstream companies in particular, how do these concentrate emissions from steel, from petrochemicals, oil and gas, etc., filter through? So we're currently actually working on a methodology to create those scenarios, basically to create a weighted benchmark based on the IPCC and IEA scenarios for downstream companies that may have lots of different emission sources in their supply chain. So what I would say is what rate of reduction for a given set of inputs or purchased scope 3 category 1 emissions, for example, that is something that's being worked on. The disclosure side from those SMEs and how they then provide this data, I think the fact that scope 3 tends to be concentrated in 1 or 2 categories can be really helpful to really just get the information that is necessary and not more, essentially.
Peter, you wanted to intervene as well?
I think I just wanted to follow up that the SBTi has a different, more streamlined approach for SMEs. I think recognizing resourcing and access to data. So there's a requirement to set targets for scope 1 and 2, but not for scope 3. But that shouldn't hold them back from doing so if they wanted to as well. But I think I just wanted to highlight that we have a different path streamlined for SMEs. Recognizing that their journey can look a little bit different.
And if I may on this one as well, what we see concretely with SME clients, it's really that the question is more, where are your main levers? And the concentrated emission, as TPI was mentioned, saying that where are the bulk of your emission, and what you could do at your level to have some concrete means and control to effectively reduce this emission. And this is where proxy Scope 3 can be particularly relevant and easiest to use when you focus on the main action that you could do at your level to impact your own footprints. So this is a way to cover the question, meaning that Scope 3 is not directly addressed as a CO2 emission per se, but you are effectively focusing on the most material areas for you, or the most representative or concentrated emissions. So this is really an interesting way to focus on. Maybe another one for you, Rob. I don't know if you have any figures on that front. Have you observed a greenium or a significantly higher reward, or at least some discrepancies or variation on the market if you compare SLB issuances that have Scope 3 and the other that only have Scope 1 and 2? You were mentioning at the beginning some figures regarding fresh numbers on the SLB market. So if you compare Scope 1 and 2 and the one that having Scope 3, did you identify some differences?
No, I myself, I didn't look at the greenium. There's other people in our team. They look at the greenium. But I just aware of the time, I can take a really good question from Eric. I'll be very quick. So he's asking about the SLB KPI target setting to be aligned with the most material issuers, material topics / issuers in the SLB issuers materiality assessment. So our assessment, which is publicly available, we do consider different sectors. We assess them differently. Cement company, we only assess their Scope 1 emissions. Steel, we assess Scope 1 and 2. And oil and gas, we assess Scope 1, 2, and 3. For other sectors that doesn't have a sector-specific pathway, I can re-emphasize here that we require all 3 scopes of emissions, or at least 80% of the total emission to be included in the KPI targets. So yes, he's absolutely right. Thanks.
Anyone, any views on the question of the let's say the difference between emissions with Scope 1 and 2 versus with Scope 3? I think it's not an easy one because there is so many factors, including market factors and market conditions, that will impact the pricing at the end. But I don't know if we're in capacity to have that direct link with the KPI themselves. I think we cover all the different questions that we have received in the Q&A. So I suggest that we conclude there. Many thanks to all of you, to the audience for your participation, and a big thanks to our speakers for your participation today. It was really insightful with, I hope, concrete actions and tips for more SLB in the coming days and months. So next session will be July in our series of SLB webinar focusing on sovereign SLB. So thanks to everyone, and have a nice day. Bye-bye.
Bye-bye.
Thank
Thank you.
Thank you very
Bye-bye.
much.